Hello Sector Watchers, this is the 38th episode of Sector Spotlight on Tuesday the 7th of July, recorded on the 6th. For those of you who don't know me, welcome to the show. My name is Julius de Kempenaer and I'm your host today. And for our regulars, welcome back. I'm glad you're joining me again. I love to hear from you, so if you watch the show on YouTube, please don't forget to like the video, or even better, share your thoughts, ideas, suggestions, etc. in the comment section below the video. I do read them and I will respond to legitimate comments or questions. Of course, you can always send an email or use any of the social media handles to stay in touch. This new month of July means that the first half of 2020 is done and dusted. And what a first 6 months we've seen. Phew! For this reason, I want to give you a heads up that the StockCharts TV team is putting together a mid-year perspective week starting July the 13th. That week, mid-year perspectives and commentary will come back in many shows, and we will close off with a great panel discussion on Saturday the 18th at 12 p.m. Eastern, which include yours truly, and you are invited. Back to Sector Spotlight for today. As it is the first Tuesday of the new month, we'll be taking a look at what is happening in asset classes and US sectors using monthly charts in combination with relative rotation graphs. But before we dive into these items, we will first have a look at what happened last week in both asset classes and sectors. Ladies and gentlemen, this is Sector Spotlight. Let's start with an overview of what happened last week in asset classes and sectors. On the left-hand side, you see the daily RRG of the sector universe that we're tracking here in Sector Spotlight. It's ending on July 2nd. That was last Thursday because the US had a holiday for the 4th of July on the 3rd. The balanced index, the VBINX, our benchmark, has returned 1.1% for that week. And we actually saw a pretty good week for commodities. By the way, I have now included ticker symbol GSG in this universe. That's the iShares S&P GSCI Commodity Index. While we have been using the iPad Bloomberg Commodity Index so far, but I'm still trying to figure out what the best one is. I'm not sure if there is a best one. It has to do with liquidity, and while we're doing our investment pyramid, I like to work with index families that I really can compare with each other, and the GSCI setup seems to have a good breakdown of commodity indexes. It's actually the dollar GNX is the index sign, and there are some dollar ticker symbols representing the sub-indexes, which we will get into in another show. Again, commodities doing very well, real estate doing very well. ITOT, the US stock market, well above the 1.1 of the balanced benchmark. Our corporate bonds doing well at 1.5%. And lagging this week were government bonds, high yield, and the US dollar. If we look at the tails, then we can see commodities, in this case it's DJP, and the other one was GSG, showing a nice rotation. They're both traveling at a strong heading. So there could be some follow-up in the week to come that we just started. If you look at real estate, almost flat, picking up a little bit of momentum, but moving very far to the left on the RRG, at least on the daily. So probably a little bit more weakness ahead, at least for the next few days. And then stock market entering the lagging quadrant, but it's not losing momentum anymore. It's actually picking up a little bit of momentum. So we could see this one starting to pick up more momentum and turning up. So I'm going to keep an eye on the stock market in the coming week. I think there are more signs that stocks will be doing well in the coming few days. Corporate bonds still doing well, lost a little bit of momentum, but strongly positioned inside the leading quadrant. And then we have government bonds. They are moving to the right, so they're picking up relative strength, but they are now starting to lose a little bit of relative momentum. Not much yet, so still also pretty positive for governments, I have to say. And then there is the high yield one. That's probably the weakest asset class in this universe. Let's move over to the right side of the screen where we have the sectors. The S&P was up 1.6%, which is a pretty good week for the stock market, as we've already seen here on the left-hand side with asset classes. Best sector, materials. And if we look at the tail, that actually curled up nicely and rotated up. Almost the whole week was positive. And last 2 days it started to move to the right, move at a strong RRG heading into improving and potentially moving further into the leading quadrant. Real estate, not very strong, picked up a little bit of momentum there. Utilities are still far on the left-hand side. They had a good week. We had a good week for real estate, good week for utilities, but they're still far to the left on the RRG. Healthcare is continuing strongly. They started the week pretty strong. That was here. This was Monday. So we had a few good days for healthcare, and this is actually Monday. I'm recording it while the market is open on Monday, the 6th of July. So last Thursday we were here. So at last Thursday's close, still looking good. Lost a little bit of momentum there for healthcare. Industrials picking up a little bit of momentum, but still inside the lagging quadrant. Consumer discretionary is starting to pick up. What you see here is a very short tail, and these I've explained that before. Short tails turn easily, and discretionary is now almost back into the leading quadrant. It's one of the few sectors that's actually traveling at a heading between 0 and 90 degrees. And then technology is actually in line with the market, but losing a little bit of relative momentum. Excuse me. But it is still the sector that is furthest to the right, so there's no doubt that technology is still the strongest sector within the S&P. Talked about healthcare. Utilities picking up a little bit of momentum, but very far to the left, so still cautious with that one. Financials. That probably, well, it's one of the weaker sectors. It's not picking up negative momentum anymore, but it's moving straight to the left, which means that it is continuing to lose relative momentum versus the S&P 500, and that does not make it a very good sector. A negative turn for staples last week. We were here. This is including today. So you see that rotation is continuing. Staples losing relative strength. Staples, originally, allegedly, a very defensive sector. So if that one starts to lose versus the S&P 500, that's considered to be good for the stock market as a whole, for the S&P 500. And we've already seen the rotation of discretionary, which is sort of contrary to the staples sector. So that pair actually suggests that there is more positive signs to come for the S&P 500. And then we'll finish it off with the energy sector. We saw that it picked up a little bit of momentum, but it's continuing to move to the left, which makes it a very weak sector from a relative perspective. And that was it for last week. Short term, these were both daily RRGs. So this is looking at, let's say, probably the next week, maybe 2 or 3 weeks out. But we're going to look at what's happening on a longer term time frame, looking at monthly charts in combination with RRGs. Let's start with asset classes. The first monthly chart that I want to look at is the one for commodities. As you can see on the weekly RRG, so showing a little bit longer term rotations, we've got DJP here on the left hand side, and I need to add GSG to that picture, and then you see that that's even further to the left with a much longer tail. It is the asset class that is furthest to the left, so it remains very weak, and we're going through a hiccup, which, given the distance from the 100 level, is very unlikely to make a complete rotation towards the leading quadrant. If we look at the monthly price chart, we see that there is this pretty massive break below important support levels, or one support level. In the GSG ETF, it's around 12.80. Yeah, 12.80. And if we go to the DJP, that's the one that we've always been looking at, we see a somewhat similar pattern where we broke out of this important range and lower. And we can also see one of the other advantages of using GSG is that there is much longer history. One of the drawbacks is that GSD is very heavily geared towards energy commodities. So it's a little bit of give and take. I don't know. For the time being, I'm gonna monitor both of them. If we go to the real estate asset class, and that's in the asset class universe, we use VNQ for that. It's a Vanguard Real Estate ETF. We see that that is bouncing off this horizontal level and going slightly up. That's causing that hiccup here in relative momentum, or that rally in relative momentum. But again, we need a lot of more upside in both price and relative before it can move towards and into the leading quadrant. One of the things that I started to do more and more lately is, when you look at a monthly chart like this, sometimes, you know, you got these huge moves that sort of distort the image. And what I found that helps is if you just change that chart to a line chart, and then you can see a much quieter picture, and all of a sudden you see that low. I remember on the bars they made lows around $60, but at the end of the month we made a low at the lower end of the range, and it looks as if we're now bouncing up inside that range, which coincides with that hiccup or that rally in VNQ on the RRG chart. More important things we see on the government bond and stock monthly charts. Let's start with government bonds, because the short-term images for stocks are pretty good, and on the weekly charts things look pretty good, and I guess also on the monthly charts things look pretty good for stocks. So you would say, like, hey, that is pretty bullish for stocks. Yes, it is, but I also want to urge a word of caution, and that's coming from the bond markets. If we look at the government bond markets, the GOVT ETF, that's showing you basically the whole yield curve. You see that it broke out of that range. We had a little bit of a sideways, you know, dropping back sideways corrective consolidation pattern. And then we broke out, and it looks as if we're going through that same sort of phase here again. We jumped, made that high around 28.50, and for the last 3-4 months we've been sort of consolidating, going slightly lower. If we go to IEF, which is the 7 to 10 year, you see a similar image. We break, we touch resistance, consolidate, we go higher, we break, and we're now consolidating. It's a monthly chart, so I don't really like to call like flags on a monthly chart, because the theoretical framework for that was based on a daily chart, but it certainly has the looks like a very sharp rise, a shallow sideways decline, potentially followed by a new rally, and that's something that I definitely keep an eye on for US bonds. And if that happens, that means that US yields, the 7 to 10 year US yield, could go massively lower still from here. If that happens, that obviously would have a, well, usually, most of the time, would have a good effect on the stock market. And if we look at stocks, the core US stock market, that is this is a very nice uptrend. If you wouldn't know that this is like COVID-19, Corona going through the world, ripping through the world, and especially if you, again, the trick with the solid line chart, you would say, hey, this is just a very nice up moving market. And it looks even better if we go to SPY, because this is what everybody knows. And this chart, I don't think I've changed my trend lines here for months. And you know, we bounced off support, we overshot to the downside, and now we're working our way higher, but we're coming through. The first line of resistance is this parallel for me, and then obviously there's the all-time high in SPY that we definitely need to keep an eye on as a serious resistance level. But look at what happens when we change this chart to a line chart. You will see a very nice rising trend, and we're approaching the closing high. So let's keep an eye on this one, because here is the close, and that was on December 2019, was 321.86. That means that if we get a monthly close of the S&P above 321.86, let's round it at 322, above 322, we have a break in the line chart for S&P, and that's definitely a bullish sign. Now there's one thing that I want to show you, because I do think it's important, and that's the relationship between stocks and bonds, and that is not super strong. This is SPY TLT. We could pick in IEF or GOVT, or doesn't really matter. They all look somewhat the same. A very nice long rally out of the 2009 bottom, which in general shows outperformance for SPY over stocks. But the high was set already at the end of 2018. And we're now significantly lower in this ratio than we were at that time. And it's a rhythm of lower highs and lower lows, and we broke below this support level, and we're now bouncing back up. And again, if we make this one a line chart, then I think you agree with me that that is in a series of lower highs and lower lows, and we're approaching resistance here. So this is not a super strong image, definitely not as strong as we would like to see it to go all in on stocks. As a matter of fact, this suggests an underperformance for stocks, but we've just seen super strong charts for stocks in pretty much all time frames, but we've also seen very strong charts for the bond market in all time frames. So from an asset class perspective, I am going to keep a neutral position in terms of the balance between stocks and bonds. I think they both look good. I think they could both go higher, so yields lower, bonds higher, and stocks higher. And for the balanced investor, it makes total sense to have a serious holding in both stocks and bonds, and that actually would mean holding something like VBINX, or a well-balanced portfolio with around 60% holdings in stocks and 40% in bonds. It would definitely be good for your risk-reward profile. Anyway, pretty good for stocks, pretty good for bonds. If both go up, it means neutral for both in an asset allocation perspective, but strong on the market as a whole, both stocks and bonds. And welcome back. In the next segment, we are going to look at the long-term trends for sectors using monthly charts in combination with the RRG for US sectors. So on the left-hand side, we have the RRG on a weekly basis, and let's just move in alphabetical order. So if we look at the materials sector, see that it's moving to the right, so it's picking up relative strength, it's continuing to pick up relative strength. What we see here is that the chart itself is not too bad, but there is this heavy overhead resistance level around $60 US, and you see that the XLB price is now sort of stalling there, and that's probably what's causing this sideways movement, so there's no pickup of momentum anymore. The trend is good, the relative is good, but we would like to see a break above that 60 level to continue to move in price and to continue to move into the leading quadrant, powered by strong relative momentum. We go to communication services, then we see a sort of similar, a nice trend, higher highs, higher lows. There's nothing wrong with this chart. If we would make this a line chart, you would see a very nice touch of that lower boundary and then a hiccup. There is this overhead resistance level around 57.5 that needs to be broken, and you see that on the RRG. The communication services sector is now rolling over and losing a little bit of relative strength, relative momentum. It's a short tail, they turn easy. It's still the third sector from the right, so it's still a strong sector. Short term, losing a little bit of momentum. A break above its previous high would definitely put in some new fuel into this sector to keep it at the right hand side. One of the better sectors, don't get me wrong. Energy, completely different picture. If you look at the, oops, wrong chart. By the way, you see that sometimes I use the unadjusted version of the sectors. Those are the sectors that are heavily involved with dividends. I like to go to the unadjusted because I think they are better suited to mark support and resistance. What we see here is that the tail of the energy sector is rolling over inside the improving quadrant, and it won't be long before it starts heading back to the lagging quadrant. And that's what you see here. If you look at all these other sector charts, they're all either pushing to or already above new all-time highs, and this is like pushing to levels that was seen in 2002, 2003, while it's already outside of that falling channel and not being able to get back in there. This is definitely still one of the weakest sector in the US. Another pretty weak sector is financials. If you look at financials, we also see a hiccup or an improvement, a temporary run up from lagging into improving. And that's what we see here. We fell out of that rising channel, but we cannot get back into it. We had a little bit of a move here intra-month, drop back. This former support level is now definitely providing resistance for the financial sector. So in the short to medium term, I don't see a lot of upside potential for financials. It's, well, at the same level in terms of relative strength as energy, so it's one of the weaker sectors according to the RRG. And it's very likely that this tail will turn around and move back to lagging when this continues to move there and maybe put in a lower high and start to move lower. Industrials, slightly better than financials, but not much. It's back above its former support level, but now pushing against former lows as resistance, not nearly in the neighborhood of taking out its all-time highs. And again, this is this is the third from the left, so this is also an underperforming sector that is going through a temporary recovery, unlikely to make it all the way towards leading. Now for the good news, I know it's getting a little bit boring, but technology is still the sector to own in the US. Last month, remember this last bar here is already a week into the new month of July. So June basically finished at a new all-time high, took out the previous high. That is a positive. the sector managed to stay above the former resistance line of the rising channel. So think about it. We broke out of a rising trend channel, dropped back, broke out again, and we now take out the all-time high. That is strong. There's nothing short of strong in the technology sector. The tail is short. It's just started to turn around. As you can see here, we were coming down shortly into weakening and then turning back up. This is a strong sector, no doubt about it. Unlike staples, where we've seen a turn into the lagging quadrant, the trend still pretty good inside the rising channel. There's nothing wrong with that. But we've discussed this before. You can have a very nice stable uptrend like staples, but it's just not rising fast enough to beat the S&P 500. And that's exactly what we see here. There's a nice stable trend in staples. There's nothing wrong with holding staple stocks, but you're just not going to beat the S&P 500. And that's why the staples tail on the RRG has turned into the lagging quadrant. I'm going to skip real estate because we saw that. Utilities is some sort of a similar story as staples. Both obviously are defensive sectors, so they're still pretty good. They're solid, but the S&P is just doing better, and that's why utilities is also moving into and inside the lagging quadrant. Healthcare, it was pretty good last week, and now we see some weakness coming in. And that is very likely because we are approaching a former all-time high. So the sector should now start to prove itself by breaking above that high. I assume that it's going to remain inside the boundaries of that rising channel. But if we start to move sideways, well, the S&P continues to move higher, then we may see healthcare moving into the lagging quadrant. It's just not going fast enough anymore. For the time being, I mean, the observations between the distance between the observations is getting shorter and shorter, so that could signal that a turn is imminent. You've got to be careful with this one. I think I would love to wait and see if it can break above this all-time high and then rejoin or re-enter the healthcare sector. Again, just like utilities and staples, it is a very nice trend. There's nothing wrong with it, but there are just a couple of other sectors that are doing better at the moment. Let's quickly move to discretionary. That's the last sector that we are going to talk about. And we see a sector that is breaking to new highs, just like technology. It's inside the leading quadrant. It lost a little bit of relative momentum while it was challenging this former all-time high. That looks to be gone now. And I want to point you to an article that I wrote about the relationship between consumer staples and consumer discretionary, and it also goes into the role of Amazon in relation to the equal weight version of the discretionary sector, RCD, and XLY, where Amazon is obviously a heavyweight. And I think there's some interesting observations to make there, because the XLY, XLP relationship can tell us a lot about the general risk on, risk off message for the stock market. And that relationship, especially when you look at the equal weight version, is sending us a risk on message for the stock market. And this was Sector Spotlight. Thank you for watching. Don't forget to like the video and leave your comments below. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern, with replays on the StockCharts YouTube channel. If you want to stay up to date on developments around relative rotation graphs and anything remotely connected to relative strength, please check out my blog on StockCharts.com. When you subscribe using the link below each article, you will get a nudge each time a new article is posted. For now, please stay safe, and I hope to see you again next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.